faithfully delivering value and interpreting global bestsellers. Hi, this is Sally with the book review. All right, today we're diving into a book called The Simplest Thing in Investing, which shares straightforward investment methods. Author Qiu Guolu boasts 26 years of securities investment experience, specializing in value investing and industry analysis. He managed private funds in China as CEO of Shanghai Gaoyi Asset Management, oversaw public funds as investment director of Southern Fund, handling 280 billion RMB assets. With international expertise, he previously served as partner at US-based Wedge Capital. In 2012, Q was honored as top fund investment figure by Financial Weekly. Q believes stock investing simplifies to one thing: finding quality companies at bargain prices. This process has two steps. First, identifying good companies, then acquiring them at reasonable valuations. Many investors complicate things by getting distracted by market noise. In investing, the simplest approach is this 180,000 character book. Let's break it down. First, identifying quality companies, then buying at good prices. Starting with step one, finding good companies. Q offers two strategies. First, focus on promising industries. Many investors overlook traditional sectors, chasing trendy industries. The popular industries aren't necessarily good ones. Take film industry. Billion-dollar blockbusters sound lucrative, but most of hundreds annual productions actually lose money. Compare this to real estate. Virtually all properties in prime locations sell profitably, with buyers queuing overnight for urban properties. The film industry has two fatal flaws compared to real estate: unstable revenue streams. Even sequels with original teams often flop. Second flaw: core assets, stars, and directors don't belong to studios. Profits flow to talent, not companies. That's why industry veterans like MGM and Warner Brothers got acquired, leaving only Disney standing. Mickey Mouse and Donald Duck never ask for pay raises. Similarly, mobile and web gaming industries lack investment value despite temporary financial appeal. Rapid product cycles mean new competitors constantly replace existing ones. Q argues flashy industries like film or gaming are actually poor investment choices. His ideal industries have three traits. First, high barriers to entry, requires specialized tech or capital that limits competition, like automotive or home appliance sectors. Second, high industry consolidation after survival of the fittest. Market leaders avoid price wars and enjoy stable profits. Best example, China's home appliance industry. From 2000 to 2005, explosive growth brought cutthroat competition with multiple brands. Most companies failed. Even surviving leaders like Gree showed stagnant stock performance initially. Media and Hire lost 30% value despite sales growth. Why? Price wars forced companies to suppress profit margins during expansion. Post-2006, consolidation saw 60 to 70% companies exit, leaving dominant players. Though market growth slowed, stable leaders delivered investor returns. From 2006 to 2011, Hire, Medea, and Gree stocks grew tenfold. Third, slow technological evolution. Fast-changing sectors like IT, communications carry higher risks. Qiu Guolu cites U.S. tech stocks, best performers over 30 years, with giants like Yahoo, Cisco, Google, Facebook delivering hundred-fold returns. Yet top investors like Buffett, Munger, Lynch, Neff, Grantham all avoid tech stocks, mainly due to rapid technological obsolescence, making them unpredictable. These three criteria lead Q to favor high-barrier, consolidated, stable industries. Market leaders emerging naturally in such sectors are his ideal targets. Q's second secret: assessing a company's pricing power. What defines pricing power? The ultimate test: can they raise prices successfully? Q once tracked a consumer goods firm with decent market share. In 2013, their 13% price hike caused 20% sales drop, forced to reverse course. Classic lack of pricing power. Similar cases: steel mills squeezed by suppliers in boom times, suffering alone during busts. Contrast this with true pricing champions. Moutai constantly raises prices effortlessly. Hallmark of premium differentiation. How to identify such companies? Qiu outlines 6 markers. First, strong brand equity, especially in gifting or conspicuous consumption sectors. Social status dynamics. People overspend on gifts while economizing daily necessities. Second, repeat customers indicating high user retention. Q avoids companies reliant on sporadic big orders, preferring steady repeat purchases. Frequent small transactions signal strong consumer loyalty. Ideal investment targets. Third marker, affordable unit pricing. Lower priced items grant sellers more pricing power as consumers are less price sensitive. High priced products make consumers more cost conscious. Take car purchases. Most buyers prioritize value for money first. Though BMWs cost more than Toyotas, BMW's net margins historically trailed Toyotas. Higher prices don't guarantee bigger profits. Fourth marker, switching costs. Example, hospitals using specific medical equipment face huge retraining costs when adopting new systems from competitors, massive time investment required. Hence, high switching costs create customer lock-in and pricing power. Fifth marker, service networks. Established automotive giants' service infrastructure is nearly irreplicable. Sixth marker, first mover advantage, especially crucial in internet sector's business model innovations. Pioneers like Alibaba's Alipay created market-defining advantages. Taobao became synonymous with e-commerce. Latecomers like JD.com needed massive spending just to compete. New entrants today struggle despite heavy investments. That concludes identifying quality companies. 2 core principles. Operating in good industries with pricing power. These principles help investors tag target companies. 1. High industry barriers with concentrated market share. 2. Clear industry leadership position. 3. Sustainable pricing power, ensuring profit growth. But stock markets involve mass psychology games. When everyone wants quality stocks, valuations soar. Should you buy regardless of price? No. Overpaying even for great companies destroys returns. So we arrive at step 2 of Qiu Guolu's investment methodology. How to acquire quality companies at bargain prices. 2 golden rules for value hunting. First, buy during overall market lows. High valuations make all stocks expensive. Finding bargains becomes nearly impossible during market highs. Conversely, depressed markets offer discounted treasures, prime buying opportunities. When does market valuation bottom? GE ratio stands as the most reliable indicator.